Most people don't realize they're losing money. Not in a dramatic stock market crash kind of way, but slowly, quietly, one small decision at a time. And the worst part is that nobody ever sat you down and told you the rules. Not your parents, not your school, not your first boss who handed you a W-2 and wished you luck. You were handed a paycheck and expected to figure out the rest. So here, you are working hard, paying your bills, maybe even putting a little aside, and still feeling like you're somehow falling behind. That feeling is real, and it's not because you're bad with money. It's because you were never shown what good looks like. There are 5 specific mistakes that almost everyone makes in their 20s and 30s. They're not obvious. They don't feel like mistakes in the moment. In fact, most of them feel completely reasonable, even responsible. But over time, each one of them quietly chips away at your financial future in ways you won't fully see until years down the road. Let's start with the one that costs people the most money without them ever noticing. The first mistake is keeping too much money in a regular checking account. Think about your checking account right now. Your paycheck lands there, your rent comes out of there. Your groceries, your subscriptions, your random Amazon purchases, all of it flows through that one account, and whatever's left just sits there, waiting. That is the mistake. Because while your money is sitting still, inflation is moving. Every year, the cost of everything around you goes up. Groceries, rent, gas, healthcare, by roughly 2 to 4% on average. If your money isn't growing at least that much, it's actually shrinking in real terms. A dollar you leave untouched for 10 years in a zero-interest account doesn't buy what it used to. You didn't lose that money all at once. You lost it one quiet year at a time. The fix isn't complicated. A high-yield savings account, which is just a savings account at an online bank that pays you actual interest, sometimes 15 to 20 times more than a traditional bank, is available to anyone. No investing experience required. No minimums in most cases. You move your emergency fund and short-term savings there, and your money at least keeps pace while it waits. The second mistake is misunderstanding debt. Not all debt is equal, and treating it like it is will either keep you broke or hold you back from building anything real. There are 2 kinds of debt worth knowing. The first is high-interest debt, credit cards, payday loans, buy now, pay later traps. This kind is working against you every single day. If you're carrying a credit card balance at 20% interest, no investment in the world is reliably beating that. Paying it off is the highest guaranteed return you will ever find. The second kind is low-interest debt, a mortgage, a federal student loan at a reasonable rate. This kind can coexist with building wealth. You don't need to panic pay it down while ignoring your retirement account. But here's where most people go wrong. They don't know which category they're in. They pay the minimum on everything, feel like they're being responsible, and then wonder why the balance barely moves. The order matters. High interest first, always. The third mistake is waiting to invest because the timing never feels right. There will always be a reason to wait. The market seems too high or too low or too uncertain. You're not making enough yet. You'll start when things calm down. But here's what you're actually doing when you wait. You're giving up time. And time is the one ingredient in investing that money cannot buy back. A 25-year-old who invests $200 a month and stops at 35 will end up with more money at 65 than a 35-year-old who invests the same amount every month all the way until retirement. That sounds impossible, but it's just math. Compound interest, which is your returns generating their own returns over time. The person who started earlier had 10 extra years of compounding. You don't need a lot of money to start. You need time, and every month you wait is a month you don't get back. The fourth mistake is lifestyle inflation, spending more every time you earn more. You get a raise and suddenly you need a better apartment. You land a promotion and your grocery bill doubles because you're buying things you used to consider a treat. The car upgrade feels earned. The nicer vacations feel deserved. And individually, all of these things might be fine. The problem is the pattern. If every increase in income immediately becomes an increase in spending, your savings rate never improves. You make more. You spend more and you feel exactly as tight as you did before, just with nicer things around you. The people who actually build wealth don't increase their spending proportionally to every raise. They let their lifestyle grow slowly, intentionally, while funneling the gap between what they earn and what they spend into something that builds over time. The fifth mistake is not having a plan, and thinking that a budget is the same thing as a plan. A budget tells you where your money went. A financial plan tells you where it's going. There's a difference between tracking expenses and actually deciding in advance what your money is for. Most people in their 20s and 30s don't have a number in their head. Not for retirement, not for a down payment, not for how many months. Of expenses they want in savings. Without a target, every financial decision happens in a vacuum. You're not making choices based on a direction. You're just reacting, and reacting to whatever life throws at you. The car repair, the job change, the unexpected medical bill. Without a plan underneath you means every surprise knocks you further off course. Here's the thing none of this requires: a finance degree, a high salary, a perfect credit score, or a lucky break. What it requires is knowing the rules, the ones that should have been taught to you years ago but weren't. You're not starting over. You're starting with information, and that changes everything. If this is the kind of conversation you wish someone had started with you sooner, there's more where this came from. Drop a subscribe and let's keep going.